So first and foremost, what is Forex trading? Right, so Forex trading, right, or the word Forex refers to foreign exchange. What you're doing is trading one currency for another. So who trades Forex and why? So there are numerous market participants, right, who trade Forex. For example, you have the central banks, corporations, and retail traders. So central banks could be because, right, they want to make their economy more competitive, right, by devaluing their currency. Okay, so this makes their currency cheaper and exports will be more attractive. For banks, they could be because they are a market maker, they are making a market in the FX market, or perhaps they are trying to hedge their own portfolio. For corporations, right, it could be because they need to buy raw materials, so they need to, get involved in the foreign exchange. For example, if I'm Toyota, I need to buy raw materials for my tire. Maybe the tire is I'm buying from India. So what I'll do is that I will need to sell some Japanese yen, right, and buy Indian rupee, right, so that I can take this Indian rupee, right, and go to companies in India to exchange for the raw materials for my tires. An example. And for retail traders, it could be because, right, you are trading the forex market to speculate, to try, earn a profit, to, generate a better return compared to, putting your money in the bank, right? So these are the few groups of traders who trades the forex market. So as you can see over here, right, this is roughly how the forex market, the web, the network of the forex market looks like. So in the center, right, the one which does the bulk of this transaction are central banks and the major banks, right? Then you have the investment funds and corporations who are trading with the banks, and then finally, right, retail traders like you and me here, retail traders, right, who trades in the market as well. So this is the hierarchy, right? You can see that at the top of the food chain is the major banks, the central banks, then followed by medium-sized and smaller banks, then the brokers, okay, hedge funds, corporations, and finally retail traders at the bottom. So this is from Baby Pips, right? Advantages of forex trading. So there are numerous advantages of forex trading. Number one, there is high liquidity, right? So unlike stocks, that sometimes if you trade penny stocks or small cap stocks, right, there is no liquidity, right, and you have to pay a very wide bid-ask spread. But for forex trading, it typically have high liquidity, so this means that you can get in and out of the trade, right, relatively easy, right, without paying a huge premium or spread on it. There is low barrier to entry. Anyone can just open a forex trading account. Doesn't really doesn't mean that you must be a high net worth individual and etc. Nope. Barrier to entry is low. Certain forex brokers allows you to trade nano lots. So this in return, right, allows you to better manage your risk. So for example, one of the big problems that I think most stock traders face is that, let's say you have small capital, let's say $500. And if you want to apply proper risk management on stocks, it can be difficult because let's say you want to risk 1% of your account. So $500 is like what, $5. If you pay the transaction cost, it's going to be more than $5, right, for stocks, right? You get your broker to do the transaction, right? I think like maybe one round trip is maybe already $10 or $20. So it's difficult to apply proper risk management on stocks, especially with small accounts. But for forex, it's possible because you can trade nano lots, right? And also forex, it doesn't have the what we call the traditional transaction cost. You only pay the spread, right? So this allows you to kind of like even risk $5 on a trade in forex if you are having the ability to trade nano lots with certain brokers. So it really helps you better manage your risk. You can trade anytime you want. Forex pretty much is the market is open 24/5 from Monday to Friday. So you wake up, the market is open. You sleep, the market is open. And yep, low transaction costs as I mentioned earlier. So just a quick recap, right? So forex trading, exchange of currencies, traded by banks, corporations, and retail traders, and these are the advantages that we covered earlier. So now, what are some of the different currency pairs in the market, right? There are three broad currency pairs that you should be aware of, right? The major currency pairs, crosses, and exotic currency pairs. So the major currency pairs, right, are typically currency pairs that are the most liquid, right? And they have a dollar element to it. For example, euro dollar, pound dollar, dollar Swiss, dollar yen, Aussie dollar, and Kiwi dollar, and dollar loonie. Notice that they all have the USD element in all of these currency pairs. And these 7 currency pairs are the most liquid currency pairs. So that's why they're called the major currency pairs, the most popular and most heavily traded currency pairs. And if you look at this, right, in 2016, right, the number one most actively traded currency pairs is USD, right, number one, followed by Euro, followed by Yen, Pound, Aussie, etc. So now let's talk about the cross-currency pairs. So cross-currency pairs are currency pairs that don't have a USD element to it. For example, Euro crosses, right, means that the currency pairs has a Euro element to it, right? Euro Swiss franc, Euro pound, Euro Aussie. The Yen crosses, right? Euro Yen, Pound Yen, Aussie Yen. Pound crosses, right, means that the currency pair have a pound element to it. Pound Aussie, Pound New Zealand, and Pound Canadian. What about exotic currency pairs? So these are usually currency pairs which are thinly traded. They have a wider bid-ask spread, okay? And the swings in this market can be more volatile as well. So some of these examples are dollar against the African rand, dollar against the Mexican peso, dollar against the Thai baht, dollar against the Indian rupee, dollar against the Turkish lira. Okay? So moving on, right, let's talk about the different Forex trading sessions. So unlike the stock markets where you have just, one session, the Forex market, you have typically three different sessions: the Asian session, the London session, and the New York session. And they all open at different times of the day. Okay, and it's even worse, right, that these times of the day are not fixed because it really depends on where you are in the world. If you're in Asia, right, your time zone, right, the time is different compared to someone in New York. So I'm just going to go with a general example, right, and assume that you are from the US, right? So for the Asian session, right, it starts at 6 p.m. to 3 p.m. EDT, right, and this is during summer period from April to October. For the London session is from 3 p.m. to 12 a.m. EDT, and the New York session is 8 a.m. to 5 p.m. EDT. Now, what if you are not in US? Maybe you're in London, maybe you're in Singapore, Malaysia, right? How do you translate this to your own local time zone? Very simple. Just go down to Google and search for Forex trading session hours, right? So I'm sure there are a few results, right? The top few one that will tell you, right, what is the current Forex session in your time zone, in your local time zone. So just do a search, right? Forex trading hour session along that lines, right? Forex trading hours right now, Forex market hour session, something like that, right? And you will know what is the current Forex trading session in your time zone. And next, right, if during winter period around October to April, right, your Asian session starts at 6 p.m. to 3 p.m. EST, London is 3 p.m. to 12 a.m. EST, and New York is 8 a.m. to 5 p.m. EST. Okay? So which is the best session to trade Forex? So I think this kind of applies to almost any markets, right? The best times to trade is when there is volatility in the markets, because only when there is volatility, only when there is price movement can you make a profit. If the market don't move, you're not going to make a profit at all, right? You can't squeeze blood out of a rock. So you need to be trading when there is most volatility in the markets. And for day traders especially, right, the most volatile session is the London session. And to be precise, right, the most volatile period is actually the London and New York overlap session. So you can have a look at this. This is from Oenda. You can see that this is the start of the London session, end of London session, start of New York session, end of New York session. So you can see that when London session starts, right, volatility has picked up. And historically, right, the market is most volatile during the London and New York overlap, as you can see over here. The volatility here is the highest during these 3 or 4 hours. Okay? Now, what about when is the best days to trade Forex? So the concept is still the same, right? You want to be trading Forex when the market tends to move, right, on a certain days, right? Which days does the Forex market tends to move the most? So Tuesday, Wednesday, Thursday generally is where the Forex market tends to move the most, right? If you look at this, this is from Baby Pips. You can see that this is the currency pair. This is the days of the week, right? And these are the movement of the movement of the currency pairs on average, right, on these different days of the week. So, for example, Euro dollar on Tuesday, it tends to move around 142 pips. On Euro dollar on Wednesday, it tends to move about 136 pips. Thursday, it tends to move about, on average, 145 pips, right? So you can see that over here, right, if you look at it, right, Tuesday, Wednesday, Thursday tends to be when the FX markets move the most, right? So if you ask me, Tuesday, Wednesday, Thursday, those are the best days of the week to trade Forex. Now, moving on, right, let's talk about some common Forex trading terminologies, right? This might be slightly different from stocks, right? But generally, the concepts, right, can be applied the same. Right, so we'll talk about what is long, what is short, what is leverage and margin, what is a pip, what is a bid and ask, and what is the spread. So what is long and short? So to put it simply, right, when you say that I'm long euro dollar, it means that, right, you're referring to the trade direction, right? You're bullish on euro dollar. You want euro dollar, right, to go up because that's where you'll make a profit. So if you are long, right, you want the market to go up so you can make a profit. If you are short, right, it means that you want the market to go down so you can make a profit. This means that you have a bearish bias. Okay. So what is leverage and margin? So leverage refers, right, to how much more you can trade relative to your account size. So let's say an example, right? Let's say you have a $10,000 trading account, right? $10,000 trading account, and you're using a leverage of, let's say, a 1 to 10 leverage, 1 to 10. This means, right, you can actually control 10 times more than your initial capital. This means your broker lets you trade up to $100,000 worth of currency, 10 times more than your initial capital. So this is what leverage means, right? How much more can you trade, right, relative to your initial trading capital? So margin is just another way of looking at it, right? If you just take 100 divided by leverage. So for example, earlier, the leverage is 10. So 100 divided by 10, it says that, your margin requirement, right? Or rather, the margin required, right, is just 10%, right? So if you want to trade $100,000 worth of currency, you only require to put up a 10% margin, which is $10,000. So it's just different ways of looking at it. One thing to point out is that leverage, right, it's a double-edged sword. You can make more in trading, but at the same time, you can also lose more. So let me share with you an example. So let's say again, you have the $10,000 trading account, all right? And you're using a 1 to 10 leverage of 100K. We'll go with a stock example. Let's say we want to buy some shares of Apple, right? Say the shares of Apple is currently at $100. So let's say, shares of Apple has now moved up, right, to $110, 110. All right, so it's an increase of 10%. So if you're trading without leverage, right, you can see that you have actually made a gain of $1,000, 1K. If you're using leverage, you have made a gain of 10K. So if you put it into perspective, right, in percentage terms, right, what has happened is that without leverage, you have made a return of 10%. With leverage, you have made a return of 100% of your money. Okay, this might, looks good, right, and sounds really awesome, but I want you to take note, right, that what happens if the shares of Apple drops by 10%. Let's say right now from 100, it moved down to $90. So your capital with $10,000, right, is a drop of 10%. So you have lost 1K. If you're trading with leverage, right, 10 times leverage, right now, a drop of 10%, you have lost 10K. So pretty much essentially you have wiped out your entire trading account, right, when the shares of Apple has dropped 10%. So this is why I say that, leverage is a double-edged sword. You want to use this, right, with responsibility. You really must know what you're doing. So if you ask me, if you want to learn more about leverage on how to better position size your trade, right, this is more advanced stuff. You can go down to my website, tradingwithrainer.com/forex-risk-management. Right, that's where you can learn more about risk management and position sizing. So now moving on, right, what is a pip? A pip stands for point in percentage. It refers to the, for most currency pairs like the crosses, the major currency pairs, it's the 4th decimal place. So let's say, for example, euro dollar right now is trading at 1.2511. Okay, so let's say it moves up by 2 pips. So what this means, right, is that it has now moved up by 2 pips. Now the price is trading at 12513. Right, so you're looking at the 4th decimal place over here, right, for the most of the currency pairs. For the yen currency pairs, it's slightly different, right? So for yen, let's say it's trading at 120.10, right? Let's say it drops, right, 5 pips. So it's now trading at 120.05, right? You're looking at this 2nd decimal place over here for the yen currency pairs, right? So bear in mind, right? So pip basically refers to the smallest price move, right, in a currency pair. And one thing to note, right, sometimes, brokers, they just try to be funny, right? You can even have something called the pipette, right? So pipette right now, for most currency pairs is the 5th decimal place. right? And for this one over here is the third decimal place. So you can really get anal, I mean, you can really get really precise about it if you want to, right? So just something to share with you, right? It's called the pipette. So what is the bid and ask? All right, so this is the bid, right, refers to the price that you can sell at, and the ask is the price that you can buy at. So whenever you are trading Forex or whenever you're trading stocks, right, it's not just one price. It's always two prices, the bid and the ask. So let me share with you an example, right? Again, let's say for euro dollar, let's say it's trading at 12001 slash 1.2003. Okay? The higher value is always the ask, and the smaller value is always the bid. So if you look at this, right, and you refer to what I just mentioned earlier, the ask is the price you can buy at. So if you want to long euro dollar right now, you want to buy euro dollar, this is the price you have to pay, 1.2003. If you want to sell euro dollar right now, this is the price that you can sell, 1.2001. Okay, so this is what we mean by the bid and the ask, the price that you can buy and the price that you can sell at. And the difference between the ask and a bid is what we call the bid-ask spread, right? So if you look at this right now, if you take this one minus this one, you realize that it's 2 pips, right? So this, in other words, right, is the spread, the transaction cost that you have to pay to transact with your broker. So generally, right, for major currency pairs, the spread, right, it tends to be tighter, it tends to be smaller. Whereas if you're trading exotic currency pairs, the spread over here tends to be bigger, wider. So in other words, you're paying more, right, to trade the exotic currency pairs. So what is the spread? Yep, as mentioned earlier, right, the difference between the bid and the ask. So now, how do you read a Forex chart, right? So let me share with you an example. Okay, so this is a Forex chart. So this one over here is from TradingView. You can go to tradingview.com over here, right, and get this access to free charts. Let's have a look at candlestick chart, right? So what you see over here right now is this red line over here is the price right now to trade New Zealand dollar. This is New Zealand dollar. Okay, so if you look at it, if you want to trade, right, let's say on the sell, you notice that again there is two price, the bid and the ask. If you want to say, for example, do you see what I do? I click trade, sell New Zealand dollar, selling at the bid. That's what we mentioned earlier, right? You always sell at the bid price. Let's say right now I want to buy New Zealand dollar. You're buying at the ask. Okay, so as you can see right now, the bid ask spread on New Zealand dollars, you just take this one minus this one is 0.4 pips. Okay, so this is the bid ask spread. So in other words, right, let me just break it down to what it all means. So let's say you want to long New Zealand dollar right now, right? So you're long, this is the price that you have to pay. So what this means is that to buy 1 New Zealand dollar, all right, you have to pay 0.66017 US dollar, right? That is the cost to buy 1 New Zealand dollar right now. You have to pay 0.66017 US dollar. Okay, so that's pretty much how it works. So moving on, that's how you read a Forex chart, all right? Moving on, right? What is a Forex lot size? So lot size refers to how much of a Forex currency pair you can buy. All right, so there are different lot size. So the first one is what we call a standard lot, 100,000 units or currencies, right? Standard lot. Mini lot, 10,000 units. Micro lot, 1,000 units, and followed by nano lots, anything below 1,000 units. So nano lot is not offered by all brokers, right? Typically, brokers that are market maker, they tend to be able to offer nano lots, right? Otherwise, the most common Forex lot size that you'll trade is either the standard or the mini lot.